After starting the day a little bit shaky, the S&P 500 actually rallied nearly 1% by the time it was all said and done. So yet another firing back higher day for the bulls on Wall Street. It wasn't enough to change the postures from bearish yet, but we did retake some of our important 30-day moving average line. So we'll get into that, see what it means for our various postures. I did notice that treasuries caught a little bit of a bounce here today. Interest rates have been a challenging element of this market recently, with interest rates going up regularly, but finally getting a little bit of a pullback in rates, and therefore bonds kind of recovering a little bit. That helps some of those areas within the stock market that have struggled a little bit more recently, like technology. And also, in some cases, some of those energy companies benefited today from rising oil prices. So that actually ties in nicely with our trade application example here for tonight's video, where I did want to show you a commodities-related trade where I sell a bull put spread on a company that's bouncing up and off of its rising 30-day moving average. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 11th, 2022. First of all, if you're new, welcome aboard. Remember to go over to our YouTube channel, click on subscribe, and then go down below in our description area and make sure you're signed up for our email distribution list so that way you can be notified whenever these videos get posted. Remember, at the bottom of those emails, you'll also find any stocks in the S&P 500 that are giving you overbought and oversold signals as well. In addition to that, we're heavy users of Twitter. I would encourage you to follow me if you're not doing so already. My handle is @BrandonVanZ. We really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got our heat map for the S&P 500 pulled up here in front of us. Mostly a green day. We did have some patches of red out there, and those patches of red largely came from the more defensive and interest rate sensitive areas. So you will notice that, for instance, utilities struggled a bit here today. We also saw the consumer staples struggle a little bit there. And then patches of perhaps some industrials and healthcare and the like. But for the most part, this was a pretty bullish picture we have here today. Illumina was one of the big stars within healthcare today. That did lead the S&P 500 up about 17% there based off of some revenue forecasts that they came out with. That's the big genetic testing firm. Speaking of tests, I've been under the weather here the last 24 hours, and so I was actually trying to go get a COVID test this afternoon. Some of you saw me tweeting about that. And holy mackerel, the line was literally 4 to 4.5 hours long. And I said, forget about it. I need to get back home to do that Market Outlook video. You guys got me 100 likes the last time I did the video. And I said, hey, I'll run through a brick wall for you in order to get that video done. So rather than sitting around waiting for a test, I'm back here trying to knock this off of my list here. But point is, some of those testing firms have been in focus over recent months and of course just since the coronavirus in general. But Illumina had been one of those areas that kind of sat things out with the DNA sequencing types of tests out there. Today was a nice rally back for that particular area. And remember, that's considered a little bit more growthy area within healthcare itself. Some of the more mundane areas like Merck and Johnson & Johnson kind of sat out today's rally. So this was a day that kind of tilted more towards the risk-on philosophy. You'll see that we had a really nice patch of green here with energy. We actually talked about energy again yesterday in my top-down trend trading class, where we focus on looking for stocks that have higher highs and higher lows and tie them into top-down analysis, where we're looking for sectors and industries that are also relatively outperforming. And so all of a sudden we're finding energy and financials really doing quite well as we kind of kick off 2022. So today was another one of those days where we saw a big rally there in some of those areas. I also happened to notice over the weekend when I got my Barron's newspaper that on the cover was nice graphics of all these commodities and talking about the big commodities boom that's taking place right now. And I think that's kind of playing into what we're seeing there with energy stocks here more recently. We'll talk about their relationship to the dollar a little bit later on when we get into our 12 grid analysis here tonight. So energy was one of the big bright spots of the day. I would also say that tech was an excellent bright spot as well. Remember, that's been one of those lagging areas. Energy has been strong, so this was kind of a continuation of what's already been working with energy. Technology, not so much. Technology has been struggling this year. And, they've been struggling so much that in some cases they were having oversold cluster signals and different things like that. A lot of that being driven by that interest rate environment that we've been talking about along the way. So today, with interest rates falling all of a sudden, remember we did that bull put spread on TLT for my trade application example here last week because I felt like interest rates had surged too far too fast to the upside. So today was a really nice day for that particular trade as bond prices started bouncing back higher and interest rates rolled over a little bit. But remember, technology, especially kind of disruptive technology, is considered long duration by the investment community. And so when the interest rate environment starts rolling over like we saw here today, that can really benefit some of those areas that last week were really struggling. How long that lasts is anybody's guess. In general, I do think that interest rates will head higher over the long term. It's just the reason I did that bull put spread last week on the Treasury bond fund was simply because I felt like it got a little bit overboard in the short term, and we needed a little bit of a stalling out period before perhaps that trend clicks into place yet again. So anyway, I think it was that interest rate movement that did seem to help those tech-related assets here today. And remember, tech is incredibly important to this market. It's the most important sector out there because of all of the weight driven by its market caps like Apple and Microsoft and Amazon and Google and Nvidia and all those types of companies. So some of it was as a result of too much oversold conditions recently. Some of it was as a result of interest rates finally giving us a little bit of a breather in that particular area. Let's go ahead and pop on over here to our 4 grid now. Quick heads up, some of you that are my premium members over at Market Scholars will know this already in all likelihood, as long as you have access to our Telegram Trade Alerts app. Not only do we give you heads up about all of our trades that David and I are doing in our trading rooms and in these Market Outlook videos, but we also give you heads up to when we update tools and different things like that. So you guys should have seen here, I think it was on Sunday, that I sent out a note that I did update 7 different charts. So if you didn't catch that, go back to Telegram to check that out. But just in case you don't access Telegram all that often and you are a premium member, be aware that it was charts 1A. So in other words, look for these ones that have January 9th, 2022 on my view right here as the ones that we've updated. So 1A, 1B, and 1D were all updated for my top-down trend trading class. Then we updated charts 4B, 4C, 4D here that we oftentimes use in these market outlook videos. And then I also did update chart 5D in this case, the U.S. sectors comparison 1 grid. The only thing I did on that one was just change the color scheme to be in alignment with my top-down or my sector selector, I should say. In these ones here that I'm showing you right now, the 4B, the 4C, and the 4D, what I needed to do was what you guys heard me reference last week when I was doing these videos. For some reason, the ticker symbol on the NASDAQ composite had changed on the Thinkorswim platform. And so I basically needed to resave over our prior grid. So we didn't have any functionality changes. It was merely cosmetic in that we needed to get the $comp, which is the new ticker symbol for the NASDAQ composite, in there by default. And that way you're not pulling up the old ticker symbol every time you're trying to access these. So just a friendly reminder to get those shared links off of our premium tools area of our website if you are a premium member, and get your charting package all spiffied up. For those of you that are not premium members, be aware that David and I offer over 50 customized ThinkScript charts out there. And so it is a big feature for our premium members. And so that would be an area that perhaps you could also investigate in the future if you have an interest in joining us here at Market Scholars. Anyway, let's get into our analysis. And you can see here, it was a nice day for the market. We started off a little bit wobbly, so most markets were kind of starting off in the red here today after a big kind of bullish day yesterday. We had all those long lower shadows yesterday. I'm sure David talked about that in his video last night, but that was a really nice feature of yesterday's market. Ended up having a lot of long lower shadows and in some cases perhaps some hammers. A lot of times you need that next follow-up day to confirm the hammer. And so it was nice that today is that next follow-up day. So there was a lot of confirmation that was taking place here today, where it doesn't necessarily mean that the downtrend is over. It just basically means that in the short term, you probably took it a little bit too far on the downside. I think this is still a market where you want to exercise caution, so you've got to be a little bit careful out there. But it is indeed possible that things got a little bit oversold to the downside, and now it's time for us to have a little bit of a reversion to the mean type of a moment here. And so we had nice follow through here today on all four of these indices. You can see the S&P 500 was up 0.92%, so nearly a whole percent today, which is a good sized day. Also notice that the label is orange. In fact, the label is orange on 3 out of these 4 charts. The only one where the daily range label is blue is here on the Russell 2000. And so what that indicates is that the Russell 2000 did not have a lot of extreme volatility within its price range today compared to its average true range. But on our other 3 charts, we did. And that makes sense. If we started low today and we started to go a little bit lower and put in some negative returns in the morning, and then that completely turned around and actually ended up having a sizable up day to the upside, then of course you're going to have a wider range there as well. So that's what those orange labels are pointing out to you there. But despite the nice moves, so to kind of put a ribbon on it, Dow Jones Industrial Average was up 0.51% today. NASDAQ Composite was a very robust 1.41% today, and the Russell 2000 was 1.05% today. Those are all some pretty strong moves. But despite those pretty strong moves, we still have bearish postures across the board. So as I mentioned to you guys on Thursday when I was last with you, which I guess would have been that candle right there on the S&P 500, I said just go into tomorrow, in other words Friday, which would have been that candle, with the assumption that the S&P 500 will move to a bearish posture. It was pretty much in the cards unless there was going to be a big up day on Friday, which was not happening. And so no surprise, at least to me and those of you that watch my video, that indeed the S&P 500 did go to a bearish posture as of Friday, and it's continued to be in that bearish posture here the last couple of days. But the more often we close at the high of the day, the higher the likelihood is that this bearish posture will be somewhat fleeting, and we will quickly work our way through it. We have to remind ourselves that although there's been really strong sell-offs and destruction in certain segments of the market, the S&P 500 just hit an all-time high here on January 4th. That was not that long ago. All of a sudden, you'll see that this moving average is green. What that signifies is price is now back above a rising 30-day moving average. And it is entirely possible that within coming weeks, we could very well take out, the new all-time high yet again. I'm not saying that's a likelihood, but, seeing the size of these two candles back to back tells us that the bulls are somewhat serious about buying the dip in this particular case. The NASDAQ Composite down below has a bit more work to do. Notice that the S&P 500 is back above its rising 30-day moving average, but notice the moving average on the NASDAQ is still red here. So as I was mentioning to you guys last week, that's the one that is really struggling the most at this moment in time. Because it sold off the hardest in this move, we shouldn't be surprised that it has also rallied the hardest since then. But the problem is the sell-off was so strong that despite the really strong 2-day rally in the NASDAQ, we still have this air pocket between where we're trading right now and this falling 30-day moving average. So there's still a lot of work to do here on the NASDAQ. I do not look at the NASDAQ and have as good of warm and fuzzy feelings as I might with the S&P 500. The S&P 500 doesn't look too terrible. You could really see it going either way. But the NASDAQ's kind of in one of those positions where you want it to prove it to you first, because right now you could say NASDAQ put in this high back here last year, right? November 22nd. We put in a follow-up high right here in late December, and that was obviously a lower high. Meanwhile, you have a series of lower lows from the beginning of December, the middle to late December, and then again here yesterday. So you actually have a pretty defined downtrend right now in the NASDAQ composite, unless proven otherwise. A lot of times your mindset with a chart that looks like that is, buy the rips and sell the dips, and the idea, or I'm sorry, sell the rips. If I didn't say that the correct way, so buy when it's really low, and then if it reverts back to the mean like we're doing right now, be prepared to sell those rips higher, because we are still in that defined downtrend. Now, if we have a different market in the next couple of months and, things start, settling down a little bit, a lot of that, by the way, is out of our control as traders, right? A lot of it is in Jerome Powell's control and what he decides to do about interest rates. If interest rates are to be hiked aggressively and in much shorter amount of time than we were originally anticipating, I would have a feeling that the NASDAQ composite will struggle in that type of an environment. And you might find a little bit better opportunities in some of the more blue chip areas out there. On the other hand, if things got taken a little bit too far with that conversation we've been hearing out of the Fed here recently, it's possible that the NASDAQ could come roaring back. Remember, there are very strong companies in the NASDAQ. Those are some of the best business models on planet Earth there when you're talking about Apple and Microsoft and those types of companies. So they certainly have it within their power to do it. It's just a matter of whether the environment is right for that right now. And a lot of people do believe the Fed when they come out and say that, we're going to be practicing quantitative tightening here sooner than you may have anticipated. But we have to also remind ourselves that people have been calling for higher rates for literally years, if not decades. Really, the interest rate environment topped out originally back in the early 1980s and has pretty much been falling ever since. So there's been all kinds of so-called bottom callers along the way that have been left on the side of the road in the rubble and they've gotten run over. So we have to remind ourselves that while this time it feels different and it feels real, that all of a sudden we are really going to have higher rates. A lot of people felt that exact same way over the years, and what has happened is further and further push lower in interest rates, in some cases overseas, negative interest rates. So it's not necessarily a shoo-in, although the evidence, I think, is a little bit more substantial and tangible right now. Until we actually see it happening, we always have to hold out that possibility that the Fed is full of a lot of talk, but not a lot of follow-through. So we'll see how that shakes out. But we do see other signs of a hot economy and inflation roaring higher and things like that to help support the Fed's decision this time around. So I, for one, do kind of take them more seriously here, but also want to be open-minded enough to think that there are a lot of different possibilities from this point going forward. So my mindset with the NASDAQ right now is let it breathe to the upside for a little bit, and then look to kind of reload the bullet chamber on your gun for short selling opportunities or bearish trades on those NASDAQ types of stocks if it looks like it is going to stall out right underneath that falling 30-day moving average there. So we still have strongly bearish posture on the NASDAQ. We also have a strongly bearish posture on the Russell 2000. Notice the difference in the pink hues, where it's a little darker shaded down here below compared to the lighter pink up above with Dow Jones and S&P 500. So similar conversation with the Russell 2000, although their chart doesn't look nearly as bad as the NASDAQ composite to me, because you are trading closer to that moving average here. There's not as big of an air pocket between those two things. You are still trading below a falling 30-day moving average here. We can't say that same thing about the Dow and the S&P 500. The S&P 500, as mentioned before, back above that rising 30-day moving average, and that has been the case for the Dow in this entire move since going back here to December, right? The Dow had done so well into the end of December, beginning of January, that although it did have a 4-day sell-off there, it never even came close to closing below that rising 30-day moving average. It did touch it at the lows of yesterday, but it bounced furiously off of that. And you kind of had the same feel today. Long lower shadows repeating one another right there, where buyers were willing to step into the merchandise at those lower prices that were available there. So, the takeaway is, it seems to me that the NASDAQ Composite and the Russell 2000 continue to be our laggards. The S&P 500 and the Dow Jones look a little bit better there. And I think the Dow Jones is setting up for an interesting bounce opportunity here. The S&P 500 is going to have a bit more exposure to maybe some of those higher tech types of companies, so they might not have the benefit of all the blue chips in the Dow, but even they are looking reasonable at this level. It's kind of a sideways chart on the S&P 500, so as I mentioned before, I could honestly see it kind of break either way. It wouldn't shock me at all if we had an all-time high within a month on the S&P 500. Then again, it wouldn't shock me at all if we were back down here to these lows at the beginning of December either. We're kind of in the middle of that range right now, and we're just kind of awaiting further evidence. But I will say that the last 2 days have been constructive for bulls with those long lower shadows. Let's take a look here at our 3 green arrows setup now. And so that'll be chart 4C. Sorry about that. It's actually 4D. There we go, 4D. And as this pulls up here, you can see that 2 of the charts have 3 red arrows, and those are the 2 at the bottom. That is not surprising, right? Given what I just told you a second ago, which is the NASDAQ Composite and the Russell 2000 appear to be our laggards right now. If you could call them the leaders, you would call it Dow Jones and S&P 500. So our 2 bottom charts here have the pink background color, suggesting that we do have a 3 red arrows signal still live on those. Remember, if the Russell 2000 has a big day tomorrow and closes above its moving average, it would regain one of those green arrows. So that's a possibility there. But NASDAQ's probably not going to do that because there's that big air pocket there still. It's going to maybe take a few days of bullishness before the NASDAQ can start working off of its red arrows. But right now, 3 red arrows on both the NASDAQ and the Russell 2000, whereas up above with the S&P 500 and the Dow Jones, there's a mix of green and red arrows there. So we don't have 3 green arrow signals, but we don't also have 3 red arrow signals. There's a mix of both of them telling us that there's some indecision in the market right now. It's not exactly clear cut what direction those particular indexes want to go right now. But we did get a green arrow back there on the S&P 500 today when it closed back above its 30-day moving average. Still has red arrows on the MACD histogram and the stochastic, so we're not necessarily in the clear, so to speak, but you got to start somewhere, and regaining one of those arrows back for the bulls I think is helpful in that case. Dow Jones never even gave up its original green arrow, right? All these other indices had a recent red arrow on the moving average, but the Dow Jones popped above that moving average back here on December 22nd and has not put in a red arrow since then. In fact, this is, some pretty constructive behavior here. We had that 4-day pullback, long lower shadows on these 2 candles here, where it kind of looks like you're going to have a little bit of an opportunity for what we sometimes refer to as a hold pattern, right? And you could really make that claim on most of these indices here, but if you ever hear David and I using that term hold, it's just an acronym, stands for close above the high of the low day. And so in this most recent move, the low day for instance, the Dow Jones was yesterday. The high of yesterday on the Dow Jones was right around 36,175. So with us closing at 36,252 today, we closed above the high of the low day, which happened to be yesterday. And that's something that you can build off of, because all of a sudden those are opportunities where those downtrending diagonal lines can be broken to the upside, and you have more robust price action after that from the technical analysis community. Let's go ahead and pop on over here to the internet, I always like to get a chance to say thank you to those of you that help support this project. As I've told you countless times, my goal is to get at least 100 people to take the 5 seconds out of their day to click like for us. If we can't get at least 100 people, remember we have several hundred people that watch these videos. And we know not all of you have a Twitter account, but I do know that I've given away some chart scripts and things like that in the past. And when I do something like that, you guys come out of the woodwork for that, so where we have, in some cases 300 people clicking like. So I know most of you have the ability to do it. It's just a matter of whether you're willing to take the 5 seconds to do it or not. As we always remind you, it takes about 3 hours of our day, sometimes a little bit longer than that, all in on doing these free videos where we don't make a single cent from them. So we do them for a couple of reasons: to educate and kind of get the word out about our business, to kind of promote our premium services where we do make money. But in this particular video, it is completely free. So in order to keep these free videos up as often as possible, we just ask one simple thing out of you: just help support us on social media, in particular Twitter there. So thank you to the 105 of you that did that last time, as I mentioned before. If you didn't do that, today was the type of day where my whole body has just been aching like you wouldn't believe. I was joking with somebody before that like the worst thing for me right now is sneezing. Like, sneezing for your body is a pretty violent thing. You don't really think of it normally when you're not aching and in pain, but my body is so aching right now with whatever I have, if it's a fever or a cold or whatever. But boy, that just sent sharp pains throughout my entire body, just sneezing. So anyway, today's a day where I didn't particularly want to be doing this video right now, but because I'm a man of my word, I say that I will do everything in my power to do the videos if you guys are supporting it and having at least 100 likes. So today is a classic example of that. So keep it up on your end. We don't think it's a big ask out of you guys. Perhaps you do. And in the end, if you make that decision not to help support the project, then you also cannot be the one that's surprised if we have a change of the schedule at some point in the future where we're not doing it as often or not as long of videos or what have you. So as long as 100 people are liking it for me, I'm reasonably pleased with that. And I will plan to do a full length, half hour plus type of a video the next time I'm scheduled to do the videos, which I typically do them on Tuesdays and Thursdays. If I'm getting less than 100 likes there, then I might just do a really quick little recap on the indices themselves that might last only 15 minutes, but would not come with a trade application example and a lot of these other analysis charts that I show you. So simple request. If you can get in the habit of doing that every single time you see David and I posting about these, I think you'll be better off and more suited for seeing additional free content for us in the future. So thank you again to all of you that help support us there. We really, really appreciate it. Also, on our website, I posted the sector selector. We kind of reviewed this already in class on Monday, but for those of you that might not have been in class, just wanted to point out that energy has just been surging here lately. It's been crazy. Now, energy was no stranger to the top slot. You can see back here, this is a rolling 3-month graphic. And for large swaths of the fall and early winter, energy was the top performing sector. But as we rolled into the end of 2021, we saw energy kind of fall off of a cliff. A lot of those oil and gas companies really started breaking major support levels and this, that, and the other thing. Well, it's been interesting. It's been like a light switch this year as we started 2022. Energy stocks have become the bee's knees once again, and everybody seems to be pushing into them. And so we've seen enough of that rotation where energy has made its way all the way back to number one. And although this was updated on Friday afternoon, as it always is, the first couple of days so far this week, I haven't seen anything thus far to suggest that energy will lose that top slot when I put this together again this coming Friday. So in other words, they're retaining their strength so far this week. We're seeing a further push into those names. We also see a big push into financials. Notice this dark green ball right here has risen from 9th slot last week all the way up to the 3rd slot this week. And so maybe not quite as dramatic as what we saw with energy, but very close to it. Both of them were dramatic moves from lows to highs in a very short amount of time. Some of the areas that are falling off, because remember, every time one sector shoots higher, it has to kind of replace another sector. Some of those areas where we are losing strength is, you can see real estate has fallen off pretty precipitously there from the number 1 rank down to number 6. We also have seen technology fall from number 2 a couple of weeks ago down to number 8 this most recent reading, and then healthcare took a big tumble there from number 5 down to number 9 as well. So we've seen a lot of transition here taking place lately. I've used the term upheaval quite often because I think of what we've seen here recently as even a little bit more robust than what I would traditionally identify as rotation. Upheaval sounds a little bit more aggressive, and that's kind of the way that I feel like the markets have been lately. Last year was a year when a lot of those compounding growth types of stocks did quite well, a lot of your FANG stocks and what have you. More recently, what we've seen is the market shift its attention to more of the defensive types of sectors where it's hunkering down when it's scared, but then in addition to that, also hunkering down in the value areas of energy and financial. So kind of an interesting mix here all of the sudden. So anyway, just be aware of some of those rotations taking place, some of it as a result of what we've seen with interest rates in recent weeks. Remember, financials, all else being equal, benefit from rising rates, whereas utilities and REITs tend to be at a disadvantage. In fact, we had a good conversation about that today in my dividend growth investing class. For those of you that missed it, it is posted there for those of you that are premium members in our trading rooms tab there. But we did cover the real estate sector here today, had a long conversation about why there's interest rate sensitivity with those types of securities. So feel free to check that out if you get some free time here a little bit later on. All right, let's go ahead and get back on track with some more analysis on our Thinkorswim charts. And I'm going to go over here to do some 12 grid analysis now, starting with chart 5A. This is our asset class 12 grid. A reminder that the background colors of these miniature charts tell us what the current posture is for the intermediate line using that market forecast technical indicator. And so on this first set here, you will see that we have 4 green charts on the board. We have the emerging markets up there on the top rung, which had a really tremendous day. Notice the emerging markets were up 2.3% today. A lot of those Chinese internet companies were roaring higher, I've seen. Kind of interesting there to see Charlie Munger tripling down on Alibaba as one example. But our other green charts are on the bottom rung, and those are gold, oil, and the U.S. Treasury yield. Now, as I already hinted at earlier in the video, today was a little bit of a pause day for the 10-year Treasury yield. Today was the first down day that we've had, for maybe the last week and a half or so. So Treasury yields fell, the 10-year fell down to 1.74%. Remember, when Treasury yields fall, bond prices themselves tend to rise. And so TLT up here in the middle rung off to the left, you can see was up nicely today. It was up 0.67%. And this is actually the second straight up day for TLT. Now remember, last week I sold a bull put spread right into the teeth of this downward move. Some people were really questioning that. And I wanted to be very clear with you guys that I was not suggesting that you necessarily should be buying TLT. What I was doing was basically saying that in the short term, I feel like the selling had been kind of indiscriminate and a little overdone to the downside in the bond market. And in fact, some of you that follow me on Twitter might have seen my retweet of, I think it was Jim Bianco over the weekend. He was saying that for the 30-year bond, it was actually the worst week in the history of the 30-year bond. That is really saying something. So we are talking about extreme movements, what we just witnessed there in the Treasury market. And it got so extreme that, of course, I was showing you guys last week, part of the reason I took that trade is because of these oversold cluster signals that showed up on the chart here. So while it might have been uncomfortable for people to say, I'm looking at this chart falling off of a cliff, and we're talking about this bullish trade idea, you can see now why that was of interest to me. And obviously there's a long time to go, so it's not like we can run a victory lap yet. We do need TLT to stay above 139. That was our sold strike on the bull put spread in the month of February. So obviously we're a long ways away from being home free, but you can see with the last 2 days of activity why I was interested in kind of fading that move. That was a historically bad downward move right there that needs to kind of get unwound to the upside. And I'm not calling for this to be a bottom and then all of a sudden we wake up later this year and TLT is at new all-time highs. What I'm suggesting is that that was overdone by selling a bull put spread where I could define my risk. I'm basically saying for the next month or so, I would expect more stable pricing action in the TLT rather than a continual plunge like we've seen for much of late December and into early January. So anyway, I for one was happy to see TLT rally in the last couple of days. In terms of some of these other green charts at the bottom here, gold and oil, remember that commodities are impacted by what's happening with the US dollar. Most commodities across the globe are priced in US dollars. And so typically the relationship that you find is that when the US dollar is weak, commodities, all else being equal, will be a little stronger than they would have been otherwise. And I think that played a key role today. You will see that all of a sudden, US dollar does not look all that good. It's been a while since I've said that, right? We were kind of testing it right back here at the end of last year, beginning of this year, where we started dipping our toe below that 30-day moving average right there. And sometimes you cut below that and you pop right back above it. In fact, back here is a good example of that around Halloween last year. You cut below that moving average, but you only spent a day or two down there and you were right back clicking within that trend. This has been a little bit more deterioration of the chart, and it seems like it's a more realistic possibility this time around that the US dollar could actually get weaker here. This was a pretty ugly candle today for the US dollar. I know it doesn't seem like it, especially for those of you that are newer, that the UUP was down a whopping 0.43%. But if you just simply look at that candle with your eyes, so let me right click and maximize this so you guys can see this a little bit better, especially those that are watching it on a cell phone. That is an aggressive candle that we just saw there today on UUP. So this is the US dollar versus a basket of other securities, with the euro being the most important. But you can see we basically closed on the lows of today's session, and in doing so, we crossed below the lows of December 31st. So we have a fairly defined downtrend, at least in the short term here. Obviously, this chart is still doing well from where it was 3 months ago, but ever since topping out here on November 24th, we've actually seen some decent deterioration there in the US dollar. And so again, that kind of ties into not only why this gold chart popped higher by 1.21% today and why oil was up 3.5% today, but we'll also tie into my trade application example a little bit later tonight. The point being, commodities are doing a little bit better right now for a variety of reasons, some of it inflation related, but in this case, I think they are getting a benefit from a falling dollar right now as well. I also think that the falling dollar really aided the foreign stocks. Remember, foreign stocks tend to do better on a relative basis if the dollar is weak, and vice versa. They do worse when the dollar is strong. So I for one, was not surprised to see the relationship play out the way that it did up on our top rung, where we saw the S&P 500 have a nice day, up 0.91%, but the foreign developed stocks did even better. They were up 1.09%, so that's kind of your Europe and Japan and Australia. And then our emerging markets foreign stocks were up 2.31%. That was a huge day for them. That's your China and India and Brazil and Russia and the like. So really good strength out of foreign instruments here today. I think a big reason behind that is that falling dollar over there. Some of it is related to commodities as well. Remember, foreign countries, all else being equal, probably have a larger exposure to commodities than the United States does. The United States has kind of transitioned into being more of a leader from a technological and digital perspective as the years have gone on, whereas some of the giants of the commodity worlds are still off of our shores. So we do tremendously well with technology here in this country, but a lot of other countries still have superior commodity-related assets out there. So when we see the US dollar falling, not only does it benefit those foreign securities that need to translate their earnings per share from euros or yen or whatever it is back into US dollars, where that benefits that relationship, but you also have the types of companies that benefit a bit more from a falling dollar outside. So you kind of have a double bonus when that occurs. So anyway, kind of interesting to see that. Also, should point out here that high yield bonds had a very nice day. They were up 0.47%. Look at that candle right there on HYG. Remember what I mentioned before, there is a closer correlation for high yield bonds to oil prices than what you'll see with these other bonds that are out there, because these are corporate bonds, oftentimes raising capital from the shakiest firms out there, and the shakiest firms out there in this recent era have oftentimes come from the energy patch. So when oil prices start perking up, there's a greater chance that those types of corporations won't have to default on their debt, and therefore high yield bonds get an extra booster on days like today when oil prices surged like this. So high yield bonds up very nicely here today. Good looking candle there. Still has the bearish posture, as you can see with the background color, but these have been a really nice back-to-back day there with high yield bonds. Bitcoin was up a little bit today. Remember, Bitcoin has been bludgeoned here in recent weeks. So I would actually call this a little bit of a whimper. I would have expected more out of Bitcoin today, to be honest. Bitcoin has often traded with a risk-on type of mentality, and so I can understand why it's really sold off in the last few weeks. But with today being a risk-on mindset type of a day where technology was one of the leaders from a sector perspective, today would have been the type of day where I would have expected Bitcoin to be up, 7 to 10% or something like that. And so I think there's maybe a little bit of challenge underneath the surface there with Bitcoin. Not that it can't be overcome, but it just seems like something's not acting quite right with Bitcoin right now. Let's go ahead and take a look here at our sector 12 grid. So that will be chart 5C. There we go. Remember, this is the market cap weighted version of it. And so there's other ways to look at sectors, including an equal weighted approach that I showed you guys on Thursday. So this is the more traditional market cap weighted approach, where you look at the background colors of these charts and they will tell you whether they have bullish or bearish intermediate postures. So as we look at this 12 grid here, we can see only 3 green charts on the board. We've got financials up at the top, we've got energy off to the right, and we've got staples down below. And I'd like to think that David and I have done a good job bringing those moves to your attention in recent weeks, because those have been the areas of strength. Now, having said that, today was an interesting day in that staples struggled to a degree, right? Again, part of that is kind of some of the interest rate movements that have been taking place and things like that. But I think a lot of it is just that risk on mindset and all of that. And with today being, a risk on type of a day, market participants were much more interested in things like technology, which was up 1.2% today, and the more cyclical areas like energy up 3.4% today, and even some of those, financials that are the value stocks up 0.88% today. So today was a day where there was less fear than there had been in recent weeks, and therefore the staples do not look as appealing on those types of days. The staples do their best on a relative basis when the rest of the stock market is scared. Today, the stock market wasn't particularly scared. One thing that did catch my eye was healthcare. Healthcare has had a pretty nice back-to-back session here. You can see yesterday was a very nice bullish engulfing candle, and we followed through today with another almost hammer-looking type of a candlestick here, where we closed near the high of the session. So, on Thursday, I definitely was not as enthusiastic about healthcare. Healthcare looked really bad at that time. But the last 2 days have gone a long ways to, at least hold out hope that, not all is lost, and perhaps there is going to be a rally in healthcare in the future. You can see that, for instance, back here at the end of November, beginning of December, healthcare did cut pretty easily through that 30-day moving average. And then after that, burst right back above that moving average. And it spent maybe about 4 or 5 days below there. So could that happen again here? I think it's possible. When I look at this chart, if I envisioned waking up a month from right now and seeing healthcare way up here, we would look back at this time as being the ideal time to be buying bounces within healthcare, right? Because if you look at this low that was placed yesterday, it is clearly a higher low than where we were trading here in December, which was a higher low than where we were trading back here in October. And obviously you have this high and then a higher high right here. So while this felt pretty uncomfortable for healthcare in the last week and a half or so on this down move, it didn't necessarily have to wreck that uptrend. We'll find out if it's got the power to do it or not, but I'm just kind of, putting that out there into the ether for consideration, because I don't want you to be surprised if that were to be what ends up unfolding from this situation here. You can see that out of all of these charts here, it does appear like discretionary and technology kind of stand out to the downside for being sectors that have strongly bearish background colors and red moving averages, which signify price below a falling moving average. So those are both very much risk-on types of sectors. So it's understandable that they've struggled recently. Question is, where do we go from here? And one thing that doesn't look so appetizing with technology is notice that we undercut those lows. So notice the difference between what's happening with technology up here versus healthcare down below. Healthcare can still make the claim that it's kind of holding that major uptrend. Technology can't really make that claim. Yesterday at the lows, we did cut through the lows of December 2nd. Now, sometimes that happens where you have that breakdown, then retest. Sometimes that happens to the upside as well, where we'll refer to it as a breakout retest. And sometimes it's just a head fake. Where a lot of people were waiting for this support level to be broken, and they start shorting technology right there, and then of course the market does its best to frustrate as many people as possible and then rips it higher immediately after that. So sometimes those types of moves can lead to kind of shaking out the weak hands, and only the strong hands survive, and maybe those strong hands would be able to kind of course correct here and kind of get us back above the moving average. But right now, that should not be the assumption. Right now, we look at that chart and we see that it's clearly breaking down on a much more aggressive level than what we've seen in the past. So anyway, interesting movements, to say the least, of what we've seen here with things from a sector perspective here recently. All right, let's get into our trade application example here today. And so I'm going to come over here to chart 3A, which is our swing trading chart. And I'm going to type in ticker symbol CF. That's Charlie Frank. This is CF Industries. And as I hinted at earlier in the video, this is a commodities-related play. This is a chemicals-oriented company that makes a lot of fertilizer and things like that for crops. And so they tend to do well when commodities are booming. And we've seen a little bit of that here more recently. Well, it caught my eye here today because, this thing has struggled since topping out here on December 28th. We've really sold off nearly every single day along the way. And on the few days where we were up, it was just barely up. So it's been a pretty persistent move lower there. But what I liked about this chart is that where we finally bottomed out yesterday was right there on top of the 30-day moving average. I like those situations where you can kind of see here that we burst above this prior resistance area back here on November 18th on this candle. So on December 21st, that was a huge candle that day. We went up and above that prior resistance area. Well, we went up 4 days in a row after that. So that was a very clean breakout that had a lot of follow through with it. But things got a little bit ahead of their skis there, and the market needed to kind of correct that excess from the top. I think the market's done a very good job of flushing some of that excess out on this particular name, and now it looks like it's gearing up for an up move once again. You will notice down below with this blue line, or the near-term line on the market forecast, that we have a very defined pattern of higher highs and higher lows, with this being the ultimate low on the blue line, and then you had a high there, then you had a higher low there, then you had a higher high there, and a higher low there, and yet another higher high today. Now, today that's not all that surprising because you see how that candle looks today. It was a nice day for this one. Remember, the trade was already done during the market session. In fact, I had to do the trade a little bit earlier than normal today since I was planning on going to get the COVID test, not knowing before I got there that there was going to be a 4-hour wait. So the trade actually got done a couple of hours before the bell today. But point being, all of you that are premium members will want to pay attention to your Telegram app to see when we're placing those trades. And what I ended up doing in this case was selling a bull put spread on this one. This one's a little bit more liquid, not the most liquid company on the planet, but a little bit more liquid because there are a little bit more traders in some of these more commodity-oriented areas. So I did a bull put spread. I think it was the February 67.50 by 65. And I targeted around a 30% return on risk with that. So anyway, as long as that trade or that stock stays above 65 between now and the middle of February, we should work out okay on that one. This one doesn't appear to have an earnings announcement coming up particularly soon, so that's always a concern during this time of a year when earnings season is starting, but this one's a little bit off cycle. You can see the last time that they reported there was November 3rd. So we got a few weeks there to kind of be in this trade and see how it shakes out there. But I was somewhat encouraged by that bounce up and off of the 30-day moving average yesterday. We had this divergence type of behavior with a rising trend on the near-term line of higher highs and higher lows at the exact same time that the price candles up above were going lower. So there was strength brewing underneath the surface, but people who were looking solely at price didn't recognize that strength. Perhaps after today, with this nice kind of hold pattern here, close above the high of the low day being yesterday, maybe they'll start recognizing what this near-term line was already starting to sniff out over the past week or so. So anyway, I'm hoping for a bounce higher out of CF. It would be helpful if the dollar would fall to help boost commodities prices in that type of an effort. But even if it doesn't, remember one of the benefits of selling a bull put spread is even if it doesn't go up a lot and just goes down, goes sideways or even down just a little bit, as long as it doesn't go down below 65, you're still going to make max gain on that trade. So it's one of the nice things about the bull put spread is it provides a bit more flexibility there for you. So that's the trade idea here for the day. Hope you enjoyed the presentation. If you did, as I mentioned before, I ask one simple thing out of you. Just click like for us on Twitter. It doesn't cost you anything, and it only takes 5 seconds of your time. So do your best on that. That'll help ensure that we can do these free videos as often as possible in the future, even on days when we don't particularly feel up to snuff, as was the case with me here today. So thanks again for checking out the video. I'll look forward to seeing you guys hopefully on Thursday later this week as well. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.